So when it comes to the salary piece, it really just depends on how your business structure is. Who are the business owners? Who are the investors? What type of business are you doing? Um, are you going to need just in-house employees? Are you going to be one of those employees? Or are you just going to be kind of just an overseer as a business owner? So really determining how in depth you're going to be within the business. For example, if you are a construction company, are you going to be going out there and doing landscaping? Are you going to be driving the forklift? Or are you going to be the one kind of behind the scenes managing the salespeople, managing the labor workers, making sure that you're communicating with the accounting teams and so forth. So once you kind of determine what your role is within the company, then you can determine, are you going to also receive a pay on an hourly basis, on a salary basis as an employee, as well as getting your profit pay from the business, on an annual basis, whether that is mid-year, quarter, or is that a full year that you're looking at your profit. Once you kind of determine that, then you can kind of determine what your salary is going to be. A lot of business owners do split their pay, so they'll get paid a regular salary, which is a lot lower than what their company payout will be. So that way they are compensated for the day-to-day work that they do. And then at the end of the year or during their fiscal year, when their quarter ends, they'll then do an evaluation on the company as a whole, and then that's when they'll also get their profit pay from the company's revenue. Starting off with a lower salary amount, when you're under about 100K to 200K a year, you're definitely in a lower tax bracket than you would if you're getting 500,000 a year just as a lump sum at the end of the year. So based off of what you're, going to get as your gross pay, you want to take that into account with how much taxes you have to pay. If you're doing one lump sum a year, you're looking to have to pay taxes on that one lump sum, and also take into consideration, any expenses and things like that you've had also throughout the year. So a lot of business owners will choose to get a monthly or bi-monthly payment from the company, so then that way their tax liability isn't so high at the end of the year. Also take into consideration if you're enrolled in any type of 401ks, any type of retirement plans or insurance plans as well that kind of help with that tax break for you. You want to make sure that you're kind of maxing out with all of those as well to help you with that. You also, as a business owner, get your tax, breaks, and kind of look at that when you're looking at your employee count as a whole. When you have other retirement plans within the company, you kind of are allowed to also apply that to your personal income tax, depending on the type of business that you have registered as. You want to make sure that you're on the same page with your accountant or your CPA. It should be very clear from the start of your business how payments are going to be distributed to those owners. If you are a sole owner, then obviously it's a lot easier. But when you're running into, this owner is maybe 75%, this owner is 25%, you want to make sure that you're taking into account with that. So throughout the year and on a quarterly basis, your accountant should be tying out your books after every quarter to make sure that they're accounting for any expenses, which will include any payouts to those owners. A lot of companies have stipulations where the owners actually don't get paid out or don't make any money from the business until they've reached 5 years or until they've reached a certain amount of gross revenue. So depending on how they structure that and how they agree upon how their payments are, that's all going to kind of stem from how your books are being kept. So making sure that you and your accountant and your CPA are all on the same page. Make sure that you guys are very clear about, how ownership is going to work, how payments are going to work. The cleanest way that I've seen is to pay out those owners on payroll, so that way at the end of the year you can take into account what they have received, and then whatever percentage they're owed or whatever additionally that they've agreed upon at the end of the year, that's the only piece that you have to pay out. But if you kind of wait that whole time period, like you said, it really is it really is a hit, not only for you as the owner, but also for the business. Especially if you're not taking into account on a daily basis that money flow and putting that stuff aside. You're not just dealing with payroll, but you're dealing with, light bills, you're dealing with rent, you're dealing with, all those type of things, supplies and stuff like that. So you want to make sure that you're taking into account all of those things, and also taking into account how much funding went into starting the business, because a lot of the payments that come back to the owners throughout that time period is essentially kind of repayment for what they put into the business. And then at what point do you now start making money for the business? You've invested, you've been reimbursed, and then now you're making a profit from it. So really trying to figure out what that structure looks like, and having a clear vision, a clear understanding with all parties will definitely help you have a smooth transition within running your company.